All right, let's jump right into it. Welcome to your fast, witty, and entirely avatar-free daily market briefing for August 11th, 2026. We are coming to you straight from the visual hum of our premium trading room, where, you guessed it, the ticker tapes literally never sleep. Today, we're dropping all the noise, completely skipping the talking heads, and getting straight to the numbers that actually matter for your portfolio. The bears firmly yanked the steering wheel today, so buckle up, because we've got a lot of ground to cover in today's explainer. Okay, let's start with the bottom line up front. The Nifty took a pretty definitive hit in today's risk-off tape, sliding down 0.5% to close at exactly 24,472. Now, this is our second consecutive down day, and honestly, giving up that massive psychological 24,500 level, yeah, that definitely left a few bruises on the intraday charts. And the Sensex? It felt the exact same pain, ending the day down at 78,154. If you're wondering where the blood on the street was actually the thickest, you really just had to look at FMCG and metals. The broader market breadth was decidedly negative today. We saw over 2,200 stocks declining on the BSE compared to just about 2,000 advancing. It was a classic textbook risk-off session, where investors were just hitting the sell button first and asking questions way later. Section 1. The macro culprits. Why the market bled. You can't just stare at the stock charts. We've got to look at the global board to find the macro villain pulling the strings today. As hopes for a US-Iran de-escalation kind of faded into the background, the West Asia risk premium came roaring back to life. Brent crude surged aggressively toward the $90 a barrel mark. For an importing nation like ours, that is a direct, immediate threat to the import bill, corporate margins, and obviously inflation. And right on cue, the currency markets reacted. They punished importers and dragged the rupee down to 95.4 against the dollar. Now sure, a weaker rupee is a nice little tailwind if you're an exporter like IT or pharma, but for the broader market, it's a massive, glaring headwind. Moving right along to Section 2, Movers and Shakers, the corporate battlefield. So who actually survived this carnage and who became a victim of the broader sell-off? Well, in a sea of red, pharma acted as the ultimate defensive bunker. ZYDUSLIFE soared 6.4%, extending to a third straight up session, thanks to a steady defensive pharma bid and some serious U.S. generics momentum. Meanwhile, the internet and financial platform complex absolutely re-rated today. NAUKRI surged 6.1% on the back of a massive Q1 report, where their profit after tax jumped over 50%. That bullish read-through lifted platform peers like POLICYBZR, which also rocketed 6.3%. And hey, don't ignore MCX, up 4.9%, just riding its options turnover momentum. But on the flip side, GODREJPROP sank 3.3% to become the top F&O loser. The culprit? A very soft Q1 showing a 42% drop in profit on limited completions, dragging it down in an already weak realty tape. And this next point brilliantly illustrates a massive structural shift for the indices, one that goes way beyond daily earnings. The exchange just announced that BSE Limited is officially replacing IT heavyweight Wipro in the Nifty 50, and that's effective September 30th. This is what we call a structural passive flow event. Millions of dollars in index funds and ETFs are going to be forced to reposition their portfolios heading into quarter end just to mirror this change. It's a slow burn catalyst, for sure, but it is one you absolutely need on your radar. All right, Section 3, Scuttlebutt, Unverified Market Buzz. Let's step away from the hard, verified numbers for just a second and check out the whispers dictating short-term sentiment. Across forums like Indian Street Bets and X, we're seeing this recurring chatter about the RBI's proposed NBFC revolving credit norms potentially squeezing the economics for SBI cards. While the final rules aren't set in stone yet, it's definitely causing anxiety over card spreads. Alongside that, there's some unconfirmed but very persistent block deal speculation creating a potential supply overhang for Paydium, rumors of an early investor trimming their stake. And we're hearing similar whispers about pre-IPO secondary blocks by early backers in the newly listed MISO. Look, again, these are just rumors, but they create a sentiment overhang that you really need to be aware of if you're holding these names. Finally, Section 4. Tomorrow's Survival Guide. So, how do we use today's autopsy to prep for tomorrow's opening bell? Let's check the options data. Traders should absolutely expect some serious index penning around the upcoming weekly expiry. Right now, the Nifty's max pain, which is the level where options buyers lose the most money, sits at 24,450, and that aligns perfectly with the highest put open interest acting as support. On the banking side, Bank Nifty is facing heavy call open interest resistance all the way up at 58,060. The BHEL lines are drawn right at these exact levels, so keep a close eye on how the tape behaves if we retest them tomorrow morning. Also, keep your eyes on the final tail of the Q1 FY27 earnings season. Sure, the big beats and misses are mostly behind us, but we still have a few heavyweights stepping up to the plate. BHEL and NYKAA are reporting tomorrow, August 12th. Then we've got Hindustan Aeronautics Limited on the 13th, followed by GRASIM rounding things out on the 14th. Any surprises here could still easily swing the respective sectors. Based on all of today's action, our tactical idea and focus for tomorrow's watch list is a long position on Hindalco. Here's the logic behind it. It's a base metals leader that's actually showing relative outperformance even in a generally soft metals tape. It benefits heavily from firm aluminum and alumina spreads, and remember that rupee weakness we were talking about earlier? That weaker rupee directly aids Hindalco's export realizations. Now, the primary risk this trade would be a sudden rollover in China demand, but right now, the tailwinds look highly compelling. And that wraps up today's explainer. Look, you absolutely don't need to suffer through boring hour-long news channels with talking heads yelling over each other or doom scroll endless financial websites just to figure out what happened. Just subscribe, smash that bell icon to get your fast daily market briefing right here at the end of the day. A quick reminder, this is personal research for educational purposes, not investment advice. Always do your own homework before hitting the buy button. I'll leave you with this provocative thought. With crude oil aggressively threatening to wreck the macro party, will the defensive sectors like pharma continue to hold the line, or is today's slide just the calm before a much deeper storm? Think about it, prep your charts, and I'll see you tomorrow.